All right. Well, we're going to kick things off. We so appreciate everyone joining for one of these hot topics, the role of business valuation and exit planning. Thanks for joining us today. I'm David Harper. I'm the National Advisory Managing Partner. If you're new to Soren, we're a top 50 firm helping specifically business owners walk through the entire life cycle of their business, traditional accounting, obviously, and also helping them prepare and walk them through an exit at some point in the future. And though you may be in unique stages of that business cycle, we want to talk today about ways we can help you prepare for that future transaction and some of the key components to what establishes value for your company in preparation for that future event. So happy to be here today. I'll let Casey and Ray introduce themselves. They both have deep backgrounds in the world of business valuation, exit planning, and transaction advisory work. So very excited to be here today and welcome everybody. Thanks for joining.
Sure. Thank you, David. So my name is Casey Carlson. I'm located here in Central Oregon. So I've got the pleasure of working with business owners over my career, which has been entirely focused on business valuation. So frankly, I'm not very good at anything else. This is the thing that I'm good at. So it's a lot of fun. I've got the opportunity over the course of my career to work with people in several different areas. So management buyouts, ESOPs, trust and estate, mergers and acquisitions. So really going deep in each one of these and helping people execute that specific plan. Now I get the pleasure of working with business owners who are more at the planning stage. So taking a step back and saying, which one of these different exit options would be a good fit for what I'm looking for? So I'm a true nerd about business valuations. I wrote a book, which was a lot of fun. So let us know if you have any interest in getting a copy of that. We'd be happy to send that over. So I'll say it right.
And,
Hey, go
yeah,
ahead.
and I'm sorry. Yeah, let me jump in real quick on this. Now that you've heard a couple of us talk, is everyone you can use the chat feature. Are we doing okay? Someone mentioned possibly an echo, but let us know how we're doing. Brady, keep us posted on your end as well. The other thing I did want to mention is this is being recorded, and we'll be sharing this presentation after the session today. There is a Q&A feature, and so feel free to use that throughout to ask any questions along the way. So,
And I'll kick it over to Ray.
All right, it's a pleasure to meet you all. My name is Ray Madrano, and I have the privilege of being a part of Soren in the Fresno office, which is located in California. You can't see it behind me right now, but we're cooking a nice about 90 degrees outside. So we're gotta love my state. I've had the privilege of being a part of business valuation since I actually started my career, and I absolutely love this type of work. I've done everything between litigation style work for divorces, shareholder disputes, putting together buy-sell agreements for people. And now I tend to focus more on the exit planning component because people are nicer, genuinely. And I also really enjoy helping people achieve their goals, right? So to me, business valuation helps people understand a fundamental, which is where am I at today in order to make a better tomorrow for themselves. So I've been able to do tons of different things throughout my career when it comes to valuation, and it's just a joy. I typically work with middle market companies, right? And smaller companies, and I just love getting to know the stories behind those companies. That's what really drives me. As far as hobbies, right? Go to the gym. I'm also a avid artisan pizza maker. So you have two pizzas there. I didn't write a book, unlike Casey. Sorry. I just make pizza. So you're looking at a nice little broccolini, Japanese seven spice infused pizza there in the front, and then a classic margarita on the back, if you were wondering. All right, next slide, please. And we're going to go ahead and kick things off with the exit planning mindset. So next slide, please. Thank you. All right, why most owners aren't ready. Let's talk a little bit about this mindset because what I've discovered is that there's a mindset issue. Okay, and I'm going to start a timer for myself because I'm a long-winded talker. I know that. So, mind shift needs to happen. Now, as a business owner, you are very good, and I'm assuming most of you are business owners. If you're not business owners, right, that's okay. I'm hoping this will still be beneficial to you. But if you're a business owner, right, you have the mindset of every single day I am running a company and trying to figure out how to make it happen. How do I execute on this, on that, fulfill my orders, make sure my clients are happy and satisfied, right? And so that is your normal day-to-day activity, and you're rewarded for that. So when we get into the realm of exit planning, you have to remember that exit planning does not equal I am immediately exiting my business. Okay? It's not the same. Just because we're talking exit planning does not mean you're going to be ready to exit in a day or two, or a week, or 3 weeks. It doesn't work that way. So I want you to think about this. When we talk about exit planning is really about taking a step back from your company and looking at your company and creating something or rearranging something or reorganizing your company to make it very attractive to a buyer. Okay. Now, there's two different types of mentalities that I've run across quite frequently. One is a lifestyle type business owner, and one is a legacy type business owner. And this is just kind of how I like to organize them in my brain, right? The lifestyle guy is the guy that is the cornerstone of his company. He's the touch point. He's out doing sales. He's out doing marketing. He's out making sure customers are fully satisfied. He's out fulfilling orders. He's out doing all of these things related to every part of the business, and all employees report to him, right? He is the linchpin. The other type of business is a lifestyle business. And a lifestyle business is one where that person is no longer the linchpin to the business. That business can exist if that person was to walk away. One of the ways I like to test this with my clients is I'll ask the question point blank, what would happen to your company if you went on a 3-week vacation tomorrow? And then I just pause. And sometimes I have this look of horror come over a person's face, right? And that kind of tells me how important the business owner is to this company. Again, we're trying to look at this business from a third party perspective. How do we make this business attractive? Because ultimately, what is retirement, right? We're trying to get out of our companies. A company should not be an identity, but it should be an asset. Okay. And again, that's a mindset shift. So keep in mind, when we're talking about selling your company and getting it ready, you as the business owner have been trying every year to get your profits to look low. That way you pay less tax. A buyer has this mindset of, why would I buy a company that is not profitable? I want to buy a company that is very profitable because that makes me attracted. And you think about this from an investment standpoint. If I have $1,000 to invest and this place is giving me 1% interest, and that's generous if we're talking about banks, right? Do I invest it there, or do I take that same $1,000 and maybe put it in a high yield money market and earn 5.25%? Better rate of return. And so these people that are interested in buying your company want to see that rate of return. They want to have that mindset and feel good that your company is profitable. And at the end of the day, really what happens in these scenarios when we're talking about retirement and getting ready to exit our companies, I found that most people just wait too late. Again, they go back to, I started exit planning, therefore that means I'm going to exit in the next couple months. And that's not the case at all. I tell people a good solid runway is really 3 to 5 years. Why 3 to 5 years? Because that time gives us the ability to plan, to be organized, to flesh out what's important to you as the business owner, and figure out how to leave this company in a way that makes you happy, that is most favorable to you. Urgency is very costly when it comes to exit planning. Okay, next slide, please. All right, so the value gap, this is something that's kind of developed, right? And many other people have said this, but there is a value gap, and it's a fundamental difference in the mindset of a business owner who believes their business is worth X, right? In fact, I'll do you one better. I'll tell you a story. So I worked with a business owner years and years ago who insisted that the value of his company was $10 million. And really great guy. He was in vitamin mineral manufacturing. Okay. $10 million. And I'd sat with him and I asked him, well, why 10 million? How did you come up with that? And he basically said that he wants to buy homes for three of his children and he wants to travel and he wants to do some nonprofit work and he wants to start a nonprofit and he wants to continue funding places in Africa. And he had all these great ideas, but the number that he chose for the value of his company was because that's how much he wanted, not because it was grounded in any tangible facts, right? And I see this a lot, right? Perceived value versus market value, where everybody thinks, well, I'm going to get, well, look at this way. A lot of business owners feel that their company is the best company ever, right? Because they've spent time and they've built that company and it's personal to them. Well, the problem is not everybody looks at things in that way. And this is where the gap comes in, right? Because now that perceived value can be kind of developed over time because of the fact we are influenced by, what we feel like we need or what we feel like we deserve. We can also be anchoring that thought into what Google told us, or maybe we can ask an AI even, well, what should my business sell for? Right? All those things are possible. What I hear a lot is, well, my friend's business sold for, and all of a sudden that becomes the number or the multiple that is stuck in that seller's brain. And we need to kind of have a sanity check on that, right? And this is why I'm such a big believer in a formal business valuation, okay? So again, there's this gap that we have to address, and we can address that gap when we take enough time, right? That 3 to 5 years, and really give us the runway we need to discuss that. Because maybe your number is the magic 10 million, but maybe your company's only worth 5 million, like the company I was working with was. Well, we have a few choices. If we have enough time, maybe there are things that we can do to make the company look more value or enhance the value. But if we don't have the time, we'll never be able to do anything to increase the value. So, like my last point is here, we can increase the value if we have the time. Next slide, please.
Yeah, and Ray, I think what you're really kind of honing in on is the way that many buyers look at this is cash flows and risk.
Yes.
What are the future cash flows, and then what's the risk of actually obtaining those cash flows in the future? Those are two major value drivers here. Yeah.
Well said, David. Well said. And those are all things that the typical business owner today is not thinking about, right? And that's what makes us, or working with us, so great because we can help you understand the mindset. So why valuation comes first? Again, this is what we were alluding to, right? It provides a baseline. And that baseline check is really, I want you to think of it this way, right? Um, Blood work, right? I've been to the doctor, I've had blood work done, right? And they take the blood work, right? And then they take my blood work and they compare it against benchmark data, right? Because they want to know where my cholesterol is. They want to know where my fasting blood sugar is. They want to know where my vitamin A is. They want to know my iron. They want to know testosterone, estrogen, all these different things, right? Because they're comparing me to the benchmark to see in what ways am I deficient in order to help me improve, right? A business valuation is very similar. Here's a snapshot in time. We could take that, compare it to benchmarks, and figure out what are the areas where we're lacking, and then work to improve those areas, which in turn enhances or increases the value. Okay? Exit planning without valuation is just guesswork. You get that, right? If we have this magical number of $10 million, we're like, this is what we want. It's not grounded in anything. We can't defend it. And we really can't feel good about presenting that to anybody that would potentially want to take over the company so anyone can retire. Valuation's not a sales pitch, it's a planning tool. Really, like I've already said, this is a tool that allows us to do a deeper dive in your company, figure out where we are today, and figure out where we want to be in the future and where we need to be when we finally decide to exit. Again, that's where that 3 to 5 years comes in. Next slide. And Casey, would you please take over now so I can stop talking and
Of
tell us a
course.
little bit by why owners misunderstand value?
Yep, happy to do it. And on that previous slide, by the way, I gotta say I love the font choice for blood work. The nice red, kind of great choice. Okay,
Pops.
so I just wanted to pick up on one thread that Ray laid down earlier, which is thinking about how people get to the numbers that they want. So there's a few different what we call mental models that tend to get owners in trouble here. So this means when an owner decides that their value is worth 10 million bucks for a faulty reason, some of these faulty reasons are laid out here. Now we have this happen. This is quite common, actually. The story that Ray told, different flavors of it, of course, but very common that business owners come to us and they don't actually know what their company's worth, but they have an idea. And then when we tell them the idea, a lot of times there's a bit of a mismatch between what the facts say and what their uh, mm, intuition tends to say. That's not the right word. Can't think of the word. Uh, few of the reasons that they might have a different perception of reality, one of them would be revenue ain't great. So the concept here is that bigger is not necessarily better. So you can have a company that does a whole lot of revenue and does not drop a lot to the bottom line. And it's not really about how much product you sell, it's about how much profit that you're making. So oftentimes we have clients that say, I have a company that does 30 million of revenue per year. What's my company worth? Well, the real question is not what your top line is, but what your bottom line is. Speaking of bottom lines, tax returns can be misleading in terms of how those present the value of your company. So your CPA, if they're doing a good job, which I'm sure they are because I know that we have a lot of Soren clients on the call, if they're doing a good job, what they're doing is depressing your taxable income for you. So what that means, unfortunately, is that when you go to sell, that number is going to be lower than what it might actually be. And so what we do is we prepare normalizing adjustments to say, hey, here's what the tax numbers are, but if we consider different choices in terms of what's actually being considered a business expense, we might get to a different number. We're doing things like removing unusual expenses, and we'll get into a little bit more of that later. But what I want you to stick in your brain right now is that what's on your tax returns is not the most important thing for driving the value of your company. Now, once we have that right number, what you might encounter is you're golfing with your pal and he says, hey, I sold my company for 6 times profit. And you say, well, gee, my profit, I just got to this beautiful normalized level from working with Casey and Ray. And they told us that my company produces profit of 1 million bucks. So 1 million bucks times six, hey, I got a $6 million company here. The problem might be that your buddy sells telescopes and you're selling socks. There's nothing similar about telescopes and socks, so the multiples that those command should also not be similar. And even if you sold a telescope, there's all kinds of differences between two different manufacturers of the same product that need to be taken into account. A few of those are listed there. Size, growth trajectory, customer mix, all of these really coming down to the point that David made earlier about risk and cash flow. Next slide, please. Well, actually, I'll pause there. David and Ray, did you have any comments that you wanted to add?
No, I think everything you've said is exactly right, right? Every business is unique and different.
Yep.
And that's kind of the problem with hearing things from our friends, right? Your
Also
friend
the
might have had a
problem.
sweetheart deal.
Yep. Also the problem with Google searches and AI. Actually, Ray and I are huge believers in AI. That's a great tool for you as long as you're using it the right way. So just making sure that the comparisons that you're making are appropriate comparisons. So, all right,
The
next.
only other point, yeah, the only other point that I would make back on that prior slide, Brady, when we're thinking about revenues, top line may not matter, but the type of revenues does.
Mhm.
The nature of revenues, whether it's recurring, non-recurring, it could be reoccurring. There could be periodic form, customer diversification. Those types of things do play a part, and we'll be getting into that more later. There's also an exit planning survey on our website that we'll introduce you to that have a lot of those questions around your revenue makeup. So more on that
Such a
to
good
come.
point. Yep. Thank you, David. All right, Brady. I'm tempted to ask you to go back to the other slide just to keep messing with Brady, but I won't. Thank you for changing slides. Uh, timing, Ray did a great point of hammering the importance of this. The one thing that I just wanted to kind of add to what Ray said, which was so well said, is the owner dependency part here. If we pick up specifically on that, so let's say that you're one of the people that Ray says what happens when you take a vacation and you start breaking out in sweats. What I want to think about there is, so how long is it going to take you to get to the point where you can transfer things like customer relationships, staffing choices, business processes that you're managing instead of someone else, financial management that you're performing? I would be shocked if that was something that you could just flip the switch and say, this whole business is connected to me in 18 different ways, but I'm going to unplug these all and plug them into someone else in a month. That's really, unfortunately, not realistic. I'm sure that all of you are very good at the business work that you do, and you've refined that knowledge and that skill set and those connections over the course of 30 years, perhaps, or more. That 30 years that you spent building is not something that you can transfer just like that. So that's another reason that's important. Look 3 to 5 years out to the exit so that we can help you identify. And there's more to it than just owner dependency, customer concentration issues that we might find, supplier risks, management bench strength, all kinds of different things that come up that take time to fix. So with that, Brady, if you could hit the next slide, I think this goes back over to Ray.
All right, let's talk a little bit about some myths here. Okay, um, this slide, we actually got quite a few myths here to kind of dispel. And there's a lot of information here. And frankly, um, with the amount of time I have, we don't have enough time to really dive into these myths and really debunk all of them completely because they are so deep and so real. And maybe we'll do future webinars on some of these myths if you guys are interested. But let's just dive into this and kind of see where this goes. Myth number one, revenue equals value. I have heard this many, many, many times over, right? Where people have in their brain, well, my company makes $21,000, no, $21 million, excuse me, in top line revenues. And I'm actually thinking of a company right now that told me this. And therefore, I mean, I should be worth at least 21 million. That is not the way people value companies. That is not the way a potential buyer will look at your company. That will set you up for just disillusionment. You are disillusioned. I'm sorry. And this is why we're doing this myth area here, right? Because I want to help you understand the truth. So buyers pay for your cash flow. This is what David was talking about, right? They want to know, well, of that 21 million, how much do you keep for yourself? The company I was alluding to, they kept about $375,000. Now, that's a good chunk, right? Not enough to make the company worth 21 million. But again, that's something that kind of came out as we did the business valuation. The last deal sets the price. No, the last deal does not set the price. And this is the reason why. When you're thinking about selling your company and getting out of your company and transferring it to someone else, a company exists within the environment, within the industry of which it occupies. Okay. So here's the thing. As a kid, there was this song about the tree and the ground and the brown and the hole and the green grass grew all around, all around. Maybe I'm aging myself here by singing that. But that's kind of how business is. You exist within a spot, your service area. Within that spot, you're in an industry. Within that industry, you're in a kind of the national economics, right, that are at work. So you have to think about it from this perspective, right? That just because the business sold 6 months ago and maybe it does something very similar to you does not mean that today the environment is as favorable. This is also why it's important going back to that 3 to 5 year planning phase, right? If you tell me you want out in the next 6 months and the industry says, no, this is a bad time to sell. Well, now you've limited yourself to selling your company for a lower amount. I can sell anytime. Well, no, you cannot sell anytime. I wish I could tell you that, right? Rush sales always attract vulture capitalists. Okay. A vulture capitalist, as I like to say, is someone that rushes in and sees that you are distressed for various reasons and says, well, heck, I'll buy your company for maybe, 50 cents on the dollar. I mean, if you want out that bad, yeah, sell it to me. That's good. And, then they can go around, buy it, improve it, and flip it, right?
Where I've
Same
got
type of
kind of
idea.
a,
Yeah,
if I could interject for a second, I've kind of an
please.
interesting story about kind of a similar situation there. I can sell
Yes.
anytime. So I was working with a client. They were looking to sell their company. The price tag was substantial, a couple $100 million, and they were selling to a private equity group. The private equity group had most of their financing through debt rather than through investors investing equity into the private equity fund. So most of what they're doing was with borrowed funds. I was on a call with them and I was working with the management with the sell side and we're talking with the buyers for a financial due diligence call and we jump in the call a few minutes early and I'm talking with the head of the private equity fund and he just looks rough and he's like, "Have you heard what's going on with Silicon Valley Bank?" And I said, "No, I'm not familiar. This was a few years back." And he was like, "It's in the news. Check it right now. They just went under, and that's going to have a ripple effect that directly connects to the interest rates that I'm using to finance this deal." He didn't say that last part out loud. I connected that dot.
Mhm.
So he got really nervous. They did close the deal, but it was if they had started this process just a little bit earlier, that Silicon Valley Bank collapse and ripple effect would have definitely made this deal not actually possible. So you can sell
Yeah.
anything. No, it's about the tree and the dirt and the grass and all of that.
Yeah. And that's a beautiful story, honestly. And unfortunately, things really do change that rapidly, right? Which is why we're saying, hey, let's make room for margins of error here. Let's allow ourselves the time. So well said, Casey. A CPA told me what it's worth. Well, I am a CPA, I will tell you this. And much like attorneys who specialize in specific areas of law, they are attorneys. They can practice in any area. However, they specialize. Okay. CPAs do this exact same thing, right? Casey and I are specialized in business valuation, right? That's where we want to live. It's where we enjoy. It's where our happy place is. Okay. So when you have a CPA do a business valuation and he hands it to you on a napkin, I wouldn't trust it very much. Okay. Buyers pay for potential. No, a buyer will never buy your potential. They want to keep your potential. Okay. They want to pay you for what's historically been proven. There's an old saying, right? Buyers want to buy your history and a seller wants to sell his future. And you end up somewhere in between, usually. Okay. But buyers don't want your potential. They don't want to pay for your potential. They want to keep their potential for themselves. My business is unique and valuable. Okay, I appreciate this. But your uniqueness is only valuable if it's transferable. Okay. Is it documented? Is there policies? Are there procedures? Is there a way for the next buyer to carry on your uniqueness or your unique style? Okay. Because if you don't have that documented and you're working off of your head, out of your own thoughts and ideas, and you know how to do things, then that's not replicable, in which case it has no value. Okay. Next slide.
Yeah, and
Oh,
just
yeah.
and Brady, you don't have to go back. You can stay right here. But Ray, just to dovetail off what you're saying in terms of buyers not willing to pay for potential, what you can be doing as a business owner now is showing the kind of growth that would lead to a continued trajectory in the future, which a buyer may be willing to pay for. If you can show year-over-year growth of 10%, 20%, et cetera, and can build that out into future forecasts, that is a powerful
Hmm.
selling point for potential buyers.
Exactly. Exactly.
And kind of on the flip side of that, that really illuminates Ray's point about buyers not wanting to pay for potential. I was working with a restaurant owner. Part of the restaurant, they had their liquor license, so they sold alcohol. And the seller told me, he's like, well, I could raise my prices dramatically for the alcohol, and that would immediately drop quite a bit to the bottom line. But if you take the sniff test on this and think like, well, how does uh, if I'm the buyer, I think I'm going to approach this skeptically and say like, how do I not know that there's other factors at play? Maybe you're going to cut down on the people who come through. It's
Hmm.
not just a matter of flip a switch and done. So, what would have worked better for this person if he had flipped that switch himself and said, I raised prices, I demonstrated my results. You're not paying for potential, you're paying for what actually happened.
Bingo.
Yep, exactly. Ultimately, it comes down, especially when you're trying to persuade someone of the value of the future, like David said, right? We can create forecasts, right? But ultimately, there needs to be a strong narrative developed that explains this is the historical, this is the trend that I've seen in the past. This is why that trend is changing in the future. This is why you will experience this, which is a higher rate of growth by 3 points than previous years because of, right? And so this is where there's a nuance when it comes to really presenting a business for sale, because there's a story and there's a narrative that has to be told in order to help the buyer understand the value that you are transferring to them. Okay. And if you do that well, you can demand higher prices. Okay, 6 more beliefs, right? That hurt sellers at the table. I know my industry multiples. Okay. Your specific deal has to do with your risk. Okay, this is what David was talking about earlier. Two components, cash flow and risk, right? Industry multiple. You're going to find later. I'm not a big fan of industry multiples. They have their place, but an industry multiple is an average, and it doesn't apply in every situation. Okay. My lease or my equipment adds value. Well, no, that could actually hurt you pretty bad, right? If it's an unfavorable lease, why would I, as a buyer, want to take on your unfavorable lease? Really? If your equipment is very, very old and you've been running it to the ground for years, right? Because you don't want to spend the money to replace that machine, fill in the blank. Well, as a buyer, I'm not going to give you top dollar because I know I have to put in a bunch of money to replace that equipment on day one. So, number three here, we don't need a team. I don't need a team. I can negotiate this myself. I cannot stress enough the value of an experienced CPA, an advisor that knows how to navigate a business sale, and an attorney really add value to the transaction. They pay for themselves at least tenfold, honestly, either from your sanity of not going crazy by the amount of information that's coming your way, or just helping you feel safe in the process because there is so much to understand. Um, I had somebody just recently, I worked with them about 40 years ago, right? We helped sell the business. And then at the last minute, the buyer backed out. And so the guy said, hey, we've been working together for about 13, 14 months. I don't see this happening. I'm going to try to do this on my own. I'm like, oh, okay. I respect that. Please, if you need help, reach out again, right? So just last week, the guy reached out and he's like, um, hi, do you remember me? I'm like, yeah, of course I remember you, James. What's going on? And he's kind of fills me in, and he basically had been trying to sell his company for the past 3 or 4 years. And because of that, he hasn't been able to run his company. So he's actually been running the company in the ground. He's been making less money each year. He's lost staff as he's been chasing all these potential buyers. And now he's really upset and really frustrated. And he said, well, would you please take me back as a client? And it's really unfortunate, right? But that's what happens. That's why it's so important to find people that you can work with, that you can trust, that know what they're doing. Because it's very hard to properly transition a company. It takes a lot of time. All right, higher asking price equals better outcome. This is not the case, right? We don't come out swinging and say, I want 10 million for this company, knowing full well it's worth 2 million. We just don't do that, right? Even setting a high price could potentially push someone off that is a really good potential candidate to buy your company, but maybe they just don't understand the value of that 10 million yet. And they need to have that explanation. They need to see the finances. Like David said, they need to see the projections. They need to understand the narrative that has been developed to sell that point to them before they feel comfortable with that 10 million. All buyers are the same. No, 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 they are not. Casey has a great slide about this coming up, so I'm not going to talk too much about this, but they are not the same. Each buyer is unique and different. Due diligence is just paperwork. I'm sorry, due diligence is like a gauntlet where everything is being thrown at you at the same time. Years ago, there was a show called American Gladiators. And it was a normal guy, right, who would have a helmet on and he'd run down this hallway, this gauntlet set up, right, with plastic foam. And then all these really big weightlifting guys were throwing medicine balls at him and trying to knock him out, right? That is your due diligence process. So take it seriously. A lot of deals will die there, and there's a lot of information that needs to be handled properly and just handled well. Next slide, please. All right, Casey, I'm tired. Your points.
All
Please
right,
talk about normalization.
I'll tag in here. So normalization adjustments are actually going to be one of the primary focus of the due diligence period that Ray was just referencing. And you can jump to the next slide here, Brady. So how this typically works or often works, there's no typical when selling your company, just FYI, it's always going to look different based on the facts and circumstances at hand. But what often happens is there's something called a quality of earnings analysis that's prepared. And the purpose of that is to say, what is the appropriate level of profit that this company can produce? And side note, that's something that's a different team within Soren. We'd be happy to help you out with if that time comes for you. Preparing quality of earnings. So the focus there, both the buyer and the seller are going to have their own opinion about what the level of profitability actually is for your company. The focus is going to be on the adjustments that are actually made. I've never seen a transaction happen where there's not adjustments to the reported earnings that are going to happen. There's going to be some level where you say that there's adjustments that are made. A few things that we like to make adjustments to are kind of that central box there, related party transactions. So if your business is doing business with another entity that you own or with a person that you are related to, there's a good chance that those terms are not at a market rate. So we want to restate those to a market rate and or to what would be expected post-transaction. So family members that are on the books, occasionally there's someone who no longer serves the company but continues to cash a paycheck. I'd love to be that person for your company. Side note, if you're hiring. But those things, that's ultimately what that is that's another form of owner benefits of ownership. And we want to show the sellers, hey, this is the total level of economic benefits of ownership. So we're going to restate all those to a market rate. Another thing that's going to happen is anything unusual that might have happened. Actually, let's jump to the next slide. I think it'll be easier to speak to that from the next one, please. Yep, so that's the bottom point there. One-time or non-recurring items. So there's some really good examples there. Legal settlements if you were engaged in unusual lawsuits, or if you had pandemic relief income, that one that, still some people might be getting their ERTC funds, things like that. So we're going to flush those out to say we remove the unusual bumps in the road, and then this is kind of the smoother trajectory that you can expect as an owner of the company. All right, I think I'm actually going to pause there. So I'll hand it back over to Ray here. I think Ray's got the next slide. If you toggle back over there, Brady.
Okay. And let's keep going here, right? I'm watching the clock here, so I'm going to kind of rush through some of these things because I think Casey's next area is actually more important, which is where he gets into buyers. Okay. So let's talk a little bit about multiples here. Multiples are a shortcut. They are an average. Okay. When is the best time a multiple works? The best time a multiple works is if I'm selling a franchise. And that is because a franchise is a business that is completely 100% owned by one company, and then it's ran down to franchisees who are told what to do, what to serve, when to serve, and even where to buy ketchup from. So it's very simple to say that a multiple will work because everybody is operating at average. That's the beauty of buying a franchise, okay? Now, your business is not a franchise. You are unique. You are an individual. How you've chosen to run your company is unique. You are an individual. This is why I think there is some value to multiples, but not a ton of value to multiples. Okay. This is why a good valuation is better than relying upon a multiple, because we will actually get into the detail and say, well, your company does this, this, and this, which makes it above average. Or your company is deficient in these areas, which make it below average, but we can change that if we tweak it in this way. Okay. Let's go ahead and move on to the next slide, Brady. So there are various things that move this multiple up and down, which is kind of what I was alluding to, right? Now, again, not going to get too deep into all this, but customer concentration, right? If you have one client that makes up a majority of your revenues, hey, that's a risk. Okay. If you don't have management and you're a lone ranger, that's a risk. Remember this whole lifestyle versus legacy type business. Okay. If you fall into the lifestyle category, you're going to have a lot of things that kind of compress or devalue the company. Whereas if you fall into the legacy category, you're going to have things that increase or expand upon your value. Okay. Some other things, right? Deferred capital expense and messy financials, right? Um, there's a lot I can say about messy financials. It's the uphill battle that Casey and I face, I feel like on almost a weekly basis, maybe sometimes daily. And it's just the way it is. Fix your financials. Please fix your financials. Um, to the other side, right, we have factors that kind of expand and increase the value. And then finally, the biggest thing that you can do to actually increase your value is what David alluded to earlier, the type of revenue that you have. Subscription revenue, contract revenue, retainer revenue, revenues that continue to come back year over year over year over year, right? Worked with a client about 2 months ago who had contracts that renew on a yearly basis. And the buyer didn't like that. And I said, okay, but let's trace how long these people have been clients. Well, the contracts, the youngest and most recent contract was 15 years old. All the other contracts were upwards in the 20s. So again, this is where we maximize our value. Brady, next slide, please. And Casey, take it away.
Alrighty, thank you, Ray. And I will say one other thing, Ray does an incredible job explaining a lot of these concepts. What we're going to do after this is send out a link, send out a follow-up with several different things included. One of those is going to be a link to Ray's Calendly to schedule, or you can email him, call him. But we'd be happy to talk more about any of these topics. As you can tell, we enjoy talking about these things. So if there's questions that you have, if you want more detail, we know that we're going through a lot here. Happy to talk more about it. Now, next slide, please, Brady. Okay, we're going to walk through a handful of different types of buyers. The first one is going to be your synergistic buyer. This one is going to be the one that usually will pay you the most for your company, but it's also the one where you're probably going to lose a lot of control in your company into the destination and what happens to your employees and whatnot. So synergistic buyers, classically, you can think about this as selling to your competitors, suppliers, or customers. So a business that's one step removed from operating with your company. Things to think about is post transaction, there's going to be some integration risk. Things are going to change quite a bit. So that's something to keep in mind of if you have a specific vision for your company and legacy is important to you and you want things to continue the way that you've done them, not so much a good fit. But on the other side, this is a highly lucrative option as well. So a couple things to think about there. Brady, if you wouldn't mind hitting the next one, please. Financial buyers. So this is typically this would be selling to a private equity fund or someone that just wants to buy it. They say, "Hey, looking to invest. I have some money, and I'm looking to you have a good business here. I just want to buy it." So the only thing that they're motivated for, or maybe not the only, but a primary driver is just return on investment. So this is an investment that they're making into your company. Couple things to think about. These are these can be a quite lucrative option, especially in the historically low interest rate environment that we have been at. So these have been pushing the synergistic multiples. Not sure how that's going to look going into the future. Maybe that'll still be the case, but something to keep an eye on. Another one that I want you to pay attention to if you do decide to sell to a private equity fund is how the transaction is structured. That bottom paragraph there has a few things that are, well, I'd say equity rollovers are very common and earnouts are occasionally put into place. Equity rollover is to say that, hey, we're going to acquire your company and then we're going to potentially merge you with other companies or whatnot. And as part of this, you're going to get an ownership slice in the new company that's formed after the integration of your company. So they'll say, I'm going to pay you 10 million bucks, but 3 million of that is going to come in the form of shares in the new company. So that's called an equity rollover. Earnouts would be where there's discrepancies around what you think is going to happen with the future of your company. And so they say, great, we'll give you 10 million bucks, but 3 million of that is going to get held back. And you're only going to get that if these specific benchmarks are hit. All right, next slide there, please. ESOPs, love this one. So employee stock ownership plans. This is where your company is sold to a trust that operates on behalf of your employees. You might hear these referred to as employee-owned companies, although employee-owned companies could mean many different things, one of which is an ESOP. You'll notice I use the word sell. So this is not you're giving away the company to your employees. No, that's not how an ESOP works. An ESOP works when you sell your company to a trust. So the problem is that trust does not have any money. It is just a piece of paper that's created, a plan, a document. So how this works is they buy your company in exchange for a loan. And then here's the beautiful thing. So we'll see bottom of that first paragraph. ESOPs are federally encouraged. In fact, you don't have to pay income tax if it's set up properly. So, or set up in a specific way, which is a very common way. This is how 70% of ESOPs are set up. So your company, rather than having an S corp that makes distributions so that you as the owner can cover your tax liability, instead, that operating company makes distributions to its owner, which is the trust, which can use those funds to repay the debt to you. So, long way of saying that ESOPs can be tax-free and they can use those tax savings to pay you back for the ownership of the company. The trade-off here to think about is it is federally encouraged, but it's also federally protected. So the government monitors these through ERISA, and they say, we created this to benefit the employees, not you as the seller. So you can only sell this at fair market value and no more. And in fact, they're rather litigious about anyone that perhaps is taking advantage of their employees by burdening them with ownership at an exorbitant price. So the trustees that operate the trust probably going to price these conservatively, which is the right thing to do to benefit the employees. So It might be, frankly, a slice below what you're going to get for some of the other options that we've taken a look at. I guess I chose to do this in descending order of value, leave you down on a low note. Maybe next one we'll do an ascending value of price. But Brady, if you could thank you. Management buyout. I guess a fun way to talk about this is I once operated a business setting up Christmas lights for people. I got tired of it. I was in college and felt like it was time to do something different. So I talked with one of my employees, John, and I said, John, do you want to buy this company? He said, sure, but I don't have any money. He was also a broke college student. I said, no problem at all. You just do your first season. I'll cut you a discounted price. After you've made the money off the company, you can pay me back. That's effectively how a management buyout works. Typically, a few things to think about. Pretty tax inefficient. It is not the most lucrative. So those are the downsides. Really love the point that's in here. The first sentence of the seller consideration says high deal certainty. That's exactly right. So if you know your management team, I talked with John. We hammered this out at Starbucks in like an hour, and it was done. And I knew that, I wasn't concerned about the legacy of it, although John did a great job with the business. But if I was, I know John and I know what John's plans are. And if there's other employees that you might want to think about how if it, if keeping the business operating a certain way is important to you, this is a great way that could ensure that.
I'm just going to jump in real quick on
Yeah.
this too, Casey, right? About management buyouts. I've done a lot of them in recent years. And the other reason that someone might choose this as opposed to another potential buyer is just the fact that there is some emotional tie to the employees, right?
Yep.
They're like, these guys have been with me for the past 10 years. I like them very much. I don't need to get the maximum amount of money from this deal. But what I want to do is I want to see these younger guys succeed and I want to help them out in the way that I was helped out when I started. Therefore, I want to do this for them and I want to help them. So
Yep.
there are other reasons. Yeah.
Exactly. It's so interesting getting to work with business owners in this case because Ray and I, a lot of what we do is boil it down to a number and say, here's the number. But that's not the only consideration by a long
Mhm.
shot. All right, next slide, please, Brady. So picking up on Ray's comment there about if you want to help someone out. So if you really want to help someone out, you can, or maybe not, maybe this is a burden, but you can transfer it to your kids one way or another. Transferring ownership to your kids, there's probably a third of what I do is helping out people with this preferred exit option. It seems to be that a lot of people choose this one. So we have expertise in helping this happen in a tax efficient way. You'll see valuation discounts mentioned there in the 20 to 40% area. Those are if we follow specific strategies designed to transfer ownership over a longer period of time and take advantage of discounts for what we call lack of control and marketability. So those are strategies that are accepted by the IRS that are employed very commonly. We work closely with estate planning attorneys to help people transfer ownership in a tax efficient manner. So with that, I'll hand it back over to Ray.
Right. Okay, let's go ahead and push through the last little bit here. Three phases in exit planning readiness, right? This is meant to kind of show you what it would be like if you worked with us, okay? We try to be very transparent in all of this, okay? So the first step is, of course, let's help you get a baseline valuation to know where you are today. Let's figure out what you have in your head as far as how much you think the business is worth versus what the actual value is as of today, and maybe do a little research to see what the market would bear for the actual price it might sell at, right? At that point, we can kind of figure out, well, where do you want to go from there, right? Do we want to work to kind of enhance this and work on making the company look better to increase the value? Or are you good enough and you're like, you know what, I've had enough of this company. I just want to get out now. We can work with that too, right? And the last step, of course, is we want to help you transition out, right? Whatever that may look like. We want to work with you towards finding a strategic buyer. We want to work with you towards vetting that strategic buyer. We want to help you ready the company. We want to help you get all the nuances, all the accounting correct. We want to help you negotiate the deal. We want to help you negotiate even all the components up front, right? That might be very costly for you. Because here's the deal. If you have like a CPA who knows what they're doing for advisory, we can get involved initially and begin shaping the deal in a way that benefits you from a tax perspective, right? Because at the end of the day, everybody wants to know, well, how much do I walk away with, right? And if we structure this deal correctly, we can make sure that we maximize how much you walk away with and minimize the amount of tax you have to pay on transitioning out. Okay. Brady, next slide, please. So we already talked about the timeline. We're CPAs here. We're an accounting firm. We take confidentiality very seriously, and we really believe in non-disclosure agreements. It's kind of why we like to be kind of the gatekeepers for our clients. You hire us, you're not listing your company and your name online with your phone number for them to call you and interrupt your day. It'd be listed through us, and so people will be calling and bothering us. And you get to focus on just what you do best, which is running your company. As little distractions as you can, with as little pain as you can. We want to help you get there, right? So from the very beginning, from that concept phase, when you develop that company to closing, when you sign that last dotted line, transition, we've got you covered for everywhere in between. All right. I think that's about it, Brady. Um, Continuing conversations. Yes. So we are going to we would love to have any questions. If you have questions, pop them in the chat right now, please, because we'd love to talk about that. I know we're kind of pressed for time. We're right up against the hour. Sorry for being so long-winded. I take responsibility for that. But we're going to send out a few pieces after this, right? A recording that basically reminds you of what we talked about here today. So you can kind of revisit this if you want for your leisure or help you fall asleep at night, whatever makes the most sense for you. Um, but also, we're going to ask a series of questions in a poll because we'd like to know from you, what do you want to hear from us, right? Casey and I have been doing this for a while, and we have a lot of different ideas, and we want to make these webinars just a regular part of what we do for the services we provide. But we want to hear from you. What most interests you? What are you scratching your head over, right? What are you uncertain about? How do I find a buyer? What is my business really worth? What's stopping my business from being sellable? What are the things that I'm doing as a business owner that are hurting my value, right? We've got all kinds of different things. So we're going to send out a survey, ask some questions like that. We've come up with a few topics for our next webinar, but we'd love to hear from you, right? This is your power to vote and tell us what you want to hear, and we will kind of grow together.
And if you could take a moment in the webinar chat, there's a link that Brady just posted here. If you just click on the link for the next to take a quick poll for the next our next webinar, Thursday, August 27th. You can see it on the slide here. If you could mark your calendars.
And you'll notice that's 3 months out. These are planned to be quarterly from now until whole of a very long time from now.
Very long time from now. That's right.
Yeah. So thank you all for joining. Any final questions? Casey, Ray, thank you both so much for putting this together, for your time. Feel free, obviously, to reach out. You'll be seeing some emails as a follow up to Ray and Casey in any ways that we can help. Please let us know. One quick thing in the chat here. I'm in Chicago area. Any regional experts in Chicago? Yes. Yeah, we can certainly connect you with some local teams, and a great starting point would be Ray, and you'll see his link to set up a time in the forthcoming email. So
And we
thank
work
you all
with
so much. Yeah,
we work
Casey.
with clients across the country. So regardless of
Yes.
where you're located, David's in Florida, I'm in Oregon, Ray's in California. We have an office in Chicago as well. So
Yeah. And it gives me a reason to visit Chicago if you reach out, so I'm just saying.
Yeah. Yep.
There you go. There you go. Well, very good. Thank you all.
Thank you
All
all.
right, well, thank you all so much.